Welcome back to the deep dive. Today we are stripping it all the way back.
All the way.
We aren't talking about, obscure technical indicators or the latest AI hype stock. We are definitely not talking about crypto.
Well,
We are going back to the absolute source code of modern investing.
the Oracle himself.
Exactly, Warren Buffett.
Yeah.
But here's the paradox that really stood out to me when we were going through the research for this.
Okay.
Everybody says they want Buffett's returns. Everyone quotes him. And yet, when you actually look at the data, at how the average investor behaves,
They do the exact opposite.
the exact opposite. Well,
It's that classic gap between knowing something
Mhm.
and, well, doing it.
Hmm.
The principles are incredibly simple, but following them feels unnatural. It just fights against every human instinct.
So instead of another biography, we're framing this deep dive as a kind of minefield guide.
I like that.
We've pulled out the 12 deadly sins of investing from decades of his letters and interviews. These are the specific traps that, keep people from building real wealth.
And honestly, just avoiding these is probably more important than being a genius stock picker. It's that whole idea of inversion.
Right.
You don't have to be brilliant. You just have to consistently avoid being stupid.
I can get behind don't be stupid as a financial strategy. Okay, so before we step into this minefield, we need to talk about situational awareness. You can't navigate it if you don't know the terrain.
Right. You need to know the temperature of the market you're in. And we actually have a specific tool for this that leads right into our first point.
Okay.
We really recommend you go to the iOS App Store and download the Buffett Indicator app.
It's a crucial piece of kit. It basically monitors for market bubbles. It gives you daily alerts based on that Buffett indicator metric.
It's like checking the weather before you go sailing.
Exactly.
And if you want to go deeper than just the alerts and really get into the mechanics of this stuff, you should check out the Deep Value Club membership.
Where can they find that?
You can find it and subscribe to the Deep Value Investing channel on Apple, Spotify, or just go to lulivse.com.
Okay, housekeeping is done. Let's get the disclaimer out of the way and then we'll dive in.
The necessary lawyer talk. All the analysis we're about to discuss is based on public sources. This is for educational purposes only. It's not investment advice. Please do your own due diligence.
All right, let's do it. We've grouped these 12 sins into 4 categories to make them easier to digest. And the first one I'm calling the art of doing nothing.
Sounds easy.
It's not. This covers mistakes 1, 2, and 8.
In finance, doing nothing is the absolute hardest thing to do.
Okay, let's start with mistake number 1. Predicting market timing. I feel like this is the one everyone is guilty of. We all want to buy at the absolute bottom and sell at the top, right?
Of course we do. But the mistake isn't wanting to do that. The mistake is thinking you can. That you can predict when those moments will happen.
But the experts on TV seem to know.
Well, Buffett has explicitly said, he has no idea what the stock market will do tomorrow or next week or next year.
That's wild. The most successful investor in history says, I don't know, but, some guy on Twitter thinks he's cracked the code.
Precisely. And the danger isn't just being wrong, it's the opportunity cost. If you sell everything to avoid a crash,
Yeah.
you almost always miss the rebound.
Oh, yeah.
And the data on this is brutal. Missing just the 5 or 10 best days in the market just crushes your long-term returns.
So you're sitting in cash, waiting for the crash, but then you're too scared to buy because the news is terrible.
And by the time you feel safe again, the market's already recovered. You missed it.
The formula is time in the market, not timing the market.
Always. Which flows right into mistake number 2, hyperactivity.
The itch to switch.
Yeah. Buffett had a great quote on this. He says, excitement is the enemy of investment.
But that's so counterintuitive. In everything else, sports, your career, more effort equals better results. You're saying in investing, trying harder can actually make you poorer.
In terms of trading activity, yes.
Yeah.
Absolutely. Think about it. Wall Street makes money on activity. They want you to trade. They get commissions, fees. But you, the investor, you make money on inactivity by holding.
The notes had this sandpaper analogy that really stuck with me.
Frictional costs. Every time you buy or sell, you pay a commission, or even worse, you pay taxes. And those little costs, they act like sandpaper, just slowly grinding away at your capital.
So for Buffett, being lazy is actually a virtue.
Lethargy bordering on sloth is a strategic virtue. Yeah.
I can finally tell people my laziness is a sophisticated financial decision. I like it. This brings us to mistake number 8. Lack of patience. It feels linked, but it's a little different.
It is. Hyperactivity is about the compulsive need to click buttons. Lack of patience is about the discipline to wait for the perfect opportunity.
And he uses a baseball analogy for this, right?
A brilliant one. In baseball, if a good pitch comes over the plate and you don't swing, that's a strike. 3 of those, you're out.
You're forced to act.
Exactly. But in the stock market, he says there are no called strikes. You can stand at the plate, and the market can throw you thousands of pitches.
General Motors at $40, Apple at 150.
And you can just stand there. You don't have to swing. You don't strike out by not swinging. The mistake is feeling like you have to do something just because you have cash.
So you swing at a bad pitch out of boredom?
Precisely.
Yeah.
The strategy is to just wait and wait and wait for that fat pitch right in your sweet spot.
Okay, so that's the art of doing nothing. Part 2 is know what you own. This covers mistakes 3 and 9.
Right. This is moving from behavior to intellectual honesty.
Mistake number 3 is ignoring the circle of competence. This phrase gets thrown around a lot. What does it actually mean?
It's not about how big your circle is. It's about knowing with 100% certainty where the boundaries are.
Staying in your lane.
And being ruthless about it.
Hmm.
The trap is following the herd into, biotech or some crypto thing you don't really understand just because your friends are making money.
You step outside the circle.
The research had a great rule for this, the one-sentence rule.
I liked this one.
Yeah. If you cannot explain how a company makes money in a single, simple sentence, you should not own it, period.
That's a harsh filter, but probably a good one. Okay, mistake number 9 is interesting. It's over-focusing on macroeconomics. This goes against, all of financial TV.
It really does, but it connects to what we just said. If you're focused on the company, you shouldn't be obsessing over what the Federal Reserve might do next month.
But Buffett doesn't look at economic forecasts at all.
He says he doesn't.
Yeah.
He views it as noise. It's uncontrollable. It's unpredictable. The mental energy you waste trying to guess interest rates is energy you should be spending reading a company's annual report.
The phrase from the sources was ripples in the river.
Right. The macroeconomy is the river. It's always flowing. If you pick a great company, a great boat, it's going to navigate the river just fine, whether there are ripples or not.
Focus on the boat, not the waves. I like that.
Exactly.
Okay, part 3, valuation and safety. This is where we get to the numbers. Mistakes 4, 7, and 10. And this starts with a huge one. Mistake 4, confusing price with value.
This is the fundamental disconnect. The maxim is price is what you pay, value is what you get. They are not the same thing.
But on the screen, they look like the same number.
On the screen, sure, but psychologically, it's all backwards for most people. When a stock price drops, they panic. They feel unsafe.
When really, if you're a buyer, a price drop is good news.
It's great news. If your favorite brand of jeans went on sale for 50% off, you'd be thrilled. If a great company with a true value of $100 a share suddenly drops to $50, you should be celebrating.
But people look at the ticker and get scared instead.
They do. They look at the electronic scoreboard instead of the playing field.
Which is a perfect segue to mistake number 7, ignoring the margin of safety.
This comes from Ben Graham, Buffett's teacher, right?
It says it is the absolute cornerstone of value investing. The classic analogy is building a bridge.
Okay.
If you need a bridge to support a 10,000-pound truck, you don't build it to hold exactly 10,000 pounds.
Right, because if one extra person gets on, the whole thing collapses. You build it to hold 30,000 pounds. That extra capacity, that's your margin of safety.
And in investing.
If you calculate a company's worth $100, you don't buy it at $95. You buy it at, say, $60. That $40 gap is your buffer. It's insurance against being wrong.
I like that. Insurance against your own stupidity. Now, mistake number 10 is kind of a history lesson. Cigar butt investing. This is a mistake Buffett admits he made, right?
Oh, yeah. Early in his career, he would look for these cigar butts.
What does that mean?
Terrible businesses, awful dying companies. But they were selling for so cheap that he figured there was one last puff of profit left in them.
Like finding a discarded cigar on the street. That's kind of gross, but it's a free puff.
Exactly.
And
he realized it was a huge mistake. Because time, he said, is the friend of the good company and the enemy of the bad company.
a bad company just rots over time.
Yes, a great company compounds. So he totally flipped his philosophy. The takeaway became, it is far better to buy a great company at a fair price than a mediocre company at a cheap price.
Okay, we're in the home stretch. Part 4, risk and character. This is less about math and more about, well, who you are. Mistakes 5, 6, 11, and 12.
And mistake number 5 is a big one. Using leverage.
Margin. Borrowing money to invest.
Buffett is so clear on this. He says if you're smart, you don't need leverage to get rich. And if you're not smart, you have no business using it.
The math is terrifying. There was a quote, any number multiplied by 0 is still 0.
That's the key. Leverage magnifies gains, sure, but it can wipe you out completely. It can take you to 0. And once you're at 0, the game is over. You can't come back.
So the only unacceptable risk is permanent loss.
Right. Now, mistake number 6, emotional instability.
This is where it gets personal.
It really does. Investing doesn't require a genius IQ. It requires high emotional stability.
The fear and greed cycle.
Exactly. The two traps.
Yeah.
You buy high because of FOMO, fear of missing out, and you sell low because of panic.
We've all felt it. You see a stock going to the moon and you feel like an idiot for not owning it, so you chase it and buy at the top.
It's a disaster. The rule is simple to say, but so hard to do. Be fearful when others are greedy, and greedy when others are fearful. If you can't control your emotions, you will not control your money.
Okay, mistake 11 might ruffle some feathers. Over-diversification? Wait, I thought diversification was like the #1 rule of investing.
It is, for people who don't know what they're doing.
Ouch.
I mean, Buffett calls it protection against ignorance. For the average person who doesn't have time to research, index funds are fantastic. But if you're an active investor, if you really think you know how to value a business,
Why would you put money in your 20th best idea?
why would you? It just dilutes your winners. His view is to put your eggs in fewer baskets and then watch those baskets like a hawk.
Concentration builds wealth. Diversification preserves it.
You got it.
Which brings us to the last one. Mistake number 12. And this one isn't about stocks at all, not investing in yourself.
This is his favorite piece of advice. He
Yeah.
says, you are your own most important asset.
The logic is kind of bulletproof.
It is. Your skills, your ability to communicate, your health. Talent can't be inflated away. It can't be taxed away. It's the one form of wealth that no one can ever take from you.
Okay, let's recap. We walked the minefield. Don't predict the market. Don't be hyperactive. Know what you own. Understand the difference between price and value. Avoid debt. Control your emotions. And invest in yourself.
When you lay it all out like that, it sounds pretty simple. But it's simple, not easy. The hardest part isn't understanding this stuff. The hardest part is fighting your own human nature every single day.
It's fighting that urge to sell when everyone is panicking.
And that's really the final thought here, isn't it? If you can just avoid these traps, if you can just not make these 12 mistakes,
Yeah.
you are already ahead of almost everyone else.
The biggest hurdle isn't the market.
It's the person in the mirror.
The man in the mirror. That's a powerful place to land. All right, before we sign off, a quick reminder to help you keep that person in the mirror in check. Go download the Buffett Indicator app on iOS. Seriously. It helps keep your head straight when the market goes crazy.
And for the full deep dive experience, join us at the Deep Value Club or subscribe to Deep Value Investing on your favorite podcast platform or at luluvc.com.
We'll be back with another deep dive soon. Until then, keep your circle defined.
And your margin of safety wide